This podcast is brought to you by AJ Bell and Shares Magazine. Shares Magazine is published by AJ Bell Media, part of AJ Bell.
Hello and welcome to the latest episode of the AJ Bell Money and Markets podcast. I'm Charlene Young.
And I am Laura Suter. Coming up on this week's show, we'll look at interest rate moves in the US and the UK and what it means for markets and your money. Also, in markets news, we'll take a look at the US-UK investment story and dip into news from Alphabet and TikTok. We'll also look at what the latest wage figures mean for the state pension triple lock, and we've got some new research on retirement expectations versus the reality.
Yeah, and sticking to the topic of pensions, I'll be talking about a change from the taxman when it comes to claiming pension tax relief. And we've also got not one, but two fund manager interviews this week, focused on investment opportunities outside of the US and the UK. Dan's been talking to Ben Preston from Orbis Global Equity Fund about why he has less invested in the US than a typical global fund, and also to Daniel Avigad from Lansdowne European Special Situations Fund about whether it's too late to benefit from strong stock market returns in Europe.
So with all of that to get to, let's dive straight in. First up, we've got Tom Sieber, who is editor of Shares Magazine and, of course, our regular markets expert. He's here to talk through the latest from central banks, both sides of the pond, and also what it means for markets.
Yes, hi, and welcome, Tom Sieber, to the show. First foray back for our new season of Money and Markets.
Thank you. Yeah, glad to be back.
Now, I should say that we are recording this episode on Thursday morning. Now, lots and lots in the news about Trump's second state visit, I should say, all the outfits, all the banquets. But we have had some important news just in from across the fund. The Fed has cut rates. But Tom, tell us by how much? Was it a split decision? What does it all mean?
Yeah, so, I mean, when the decision first came out, there was a bit of volatility. So it was a 25 basis point cut, which was pretty much exactly what the market was expecting. Ultimately, US markets finished flat overnight. So, there wasn't a huge reaction either way. I think that probably reflects the fact that the accompanying comments from the Fed chair, Jerome Powell, were a bit kind of unclear. They were quite, I don't know if deliberately so. He wasn't, he was trying not to give too much away, but he did confirm the Fed is kind of focused now on what is a kind of softening labor market in the US. There's sort of two things the Fed looks at when it's deciding what to do with rates. It looks at the labor market, but it also looks at inflation. And it suggests that, they're more focused on the labor market at the moment. And that might hint that, there are some more rate cuts to come. You asked if it was kind of a unanimous decision, and it wasn't. And that's one of kind of a few sort of interesting subplots, I suppose. So the recently appointed Stephen Moran, who's a Trump appointee, was the kind of lone dissenting voice. He voted for, what is now come known as a jumbo kind of or 50 basis point cut, I should say.
A jumbo, all right.
A jumbo cut. And Trump has been quite vocal about what the Fed's doing, about the kind of trajectory of interest rates. And he's talked about cutting rates to 1%. But apart from Iran, it's notable that the majority of the kind of committee that set rates at the Fed are kind of expecting rates to remain at or above 3%, all the way through 2027. So, something's got to give potentially, I suppose, given what Trump has been saying. On that, though, there was also an interesting kind of detail that two earlier Trump appointees and two people who've kind of been mooted as candidates to replace Jerome Powell as Fed chair next year, so that's Governor Waller and Bowman, they didn't dissent. They stuck with the sort of the rest of the Fed governors. And that might have been kind of seen as quite good news for the market, because obviously we have had these fears about Fed independence and that being potentially under some threat. So if it eases that, I think that's potentially a good thing.
Yeah, absolutely. And, looking over here, as I mentioned, we are Thursday morning at the moment. So just before the Bank of England is expected to make a decision. But, we've seen lots and lots coming out now, data pretty much nailed on for a hold and no further cuts expected for the rest of the year. So that's what we are expecting later today. Probably disappointing news for the Chancellor as well, do you think?
Yeah, probably. Yeah, I mean, I guess she would, like the kind of feel good factor of a cut in rates. Although, it's notable that despite the fact, the Bank of England has been cutting rates, actually gilt yields, particularly long-term gilt yields, have been going up anyway. So, it's and that affects things like the mortgage market. So, the influence of rate cuts maybe it's obviously important, but there are other factors as well. So yes, I think as you say, though, it's very likely, particularly given the inflation number that we saw earlier this week, and within that there was quite sort of strong inflation in food prices. I think it's pretty likely that they will keep rates on hold, not just today, but also for the remainder of the year.
Yeah, and kind of pivoting back to the US, we mentioned the state visit, a whole host of announcements, good news for investment in the UK. Could you just talk us through what has been announced and any other company news that's popped up?
Yeah, exactly. Yeah. So, I mean, I think, obviously the timing wasn't coincidental, sort of heralding the state visit. There were a couple of kind of particularly sort of significant announcements. So one of them involved Centrica energy company, which it's had a very sort of, or its share price saw really strong returns after the invasion of Ukraine by Russia, and when we saw a big spike in energy prices. But there have been some questions about its long-term kind of strategy, and the fact that it's going to be involved with this US company called X Energy on a project around small modular reactors. So this is trying to sort of develop ways of getting nuclear energy as a bigger component of the kind of power generation in the country, but without the kind of investment involved in setting up, traditionally setting up kind of large nuclear power plants. So, it's interesting, definitely. And the shares kind of moved a bit higher on the news, so it suggested the market was quite sort of pleased to see this. But if you look at the kind of the track record of developing these small modular reactors, the one that was kind of closest to deployment in the US, it's called the Carbon 3 Power Project, was cancelled less than 2 years ago thanks to rising costs. And I think that reflects the fact that there is definite excitement about the potential for this technology, but it is still kind of somewhat unproven at this stage. So it might not be a kind of smooth path, and it might be a while before you see that show up in Centrica's sort of profit and loss, I suppose, in terms of this project actually having a kind of meaningful impact. The other kind of significant news that came ahead of the state visit was that the owner of Google, Alphabet, is going to invest £5 billion in AI in the UK. So initially it's going to open a $1 billion data center in Waltham Cross, and they're going to expand on this site, and they're going to provide some funding for a London-based company called DeepMind, which is run by the British Nobel Prize winner Sir Demis Hassabis, and that's deploying AI to sort of basically revolutionize or attempt to revolutionize scientific research. Just while we're on Alphabet, it was kind of a significant week for them in other ways too, because they joined what is a pretty exclusive club, attaining a $3 trillion valuation for the first time. So Apple, Microsoft, and Nvidia are the other companies that have got a valuation above that. And obviously Nvidia is actually in a class of its own in this sense, because it's got a $4 trillion plus market cap. And I think it's easy to sort of take those things for granted. But, when I was looking at it took, if you think about the history of sort of the stock market all the way back, it took until 2018 to get just $1 trillion company. That was Apple. Yeah. And now we've got 4 companies worth, more than 3 times that. So it is pretty staggering, really.
Yeah, and did notice, actually, I was looking at the state visit stuff, and the heads of all of these companies obviously had a place at the table with the king and the president. Was it last night? So yeah, joining the 3 trillion, 4 trillion club, and definitely getting a seat at that big royal table. And one of those companies you mentioned in that club, Microsoft, also announcing a huge investment into the UK itself as well.
Yeah, even bigger. This was $30 billion. And it was notable to see that the boss of Microsoft talked about how it could, boost the UK economy immediately. So, this is, time will tell, the full impact of this, on the UK economy, on jobs, things like that. But it is obviously, a positive thing, and could be potentially significant in the future.
Brilliant. And speaking of other deals, what's happening with TikTok and ByteDance? We're hearing stuff. Don't think anything's quite over the line yet, but it seems like something's been teased.
Yeah, exactly. So it's kind of, a classic Trump move, I guess. He's hinted at a deal, but there's no sort of full detail yet. So there's ByteDance and which is the owner of TikTok, has obviously been kind of caught up in the trade talks between the US and China. And both sides kind of are, looking to project strength, I suppose, and they don't want to kind of give anything away. But at the same time, they probably don't want trade to entirely shut down. And China kind of, I think, will want to see TikTok operate in the US. It's one of the big sort of tech success stories over the past decade from the country. And, it's kind of, I suppose, testament to China's ability to create something that really is a global force. But the US has had kind of security concerns about the app, what China might be doing with users' information, that kind of thing, whether or not it could be used for propaganda. So it's been finding middle ground that this sort of satisfies both sides, which has been pretty difficult. And the framework deal that's been agreed is kind of interesting in that context. We're expecting potentially more information. You said we're recording sort of Thursday morning, potentially at the end of this week. And, there might be some interesting takeaways from that beyond TikTok, because, the way this deal is agreed might give a bit of an indication of how sort of future deals are struck between the US and China. Previous suggestions have been that ByteDance might license its algorithm to a kind of a US party so that they can kind of continue sort of, or have in continuity of service in the US. But, with a US company involved to sort of give a bit of reassurance to the US sides that some of those concerns about propaganda or, users' data are being addressed. And one company that's potentially been pegged is Oracle. And Oracle is a company that's been in the headlines, quite a lot recently. It came out with some very, very strong results suggesting that it's managing to sort of tap into the AI theme. So that would be interesting in itself.
Thanks, Tom. So interest rates is probably one of the things we're asked about the most, wouldn't you agree, Charlene? When they're likely to fall, by how much? Obviously, because it impacts everyone's mortgages, savings rates, markets, all areas of their finances, really. So I'm sure that will continue to be the hot topic in the months to come and keep us busy.
Indeed. But now over to the state pension. The triple lock is once again in the spotlight, and the latest earnings figures out this week play a huge role in setting the increase for next year. Laura, can you take us through those numbers and what they could mean for next year's rise?
Yeah, do you think I should do a little triple lock explainer here for anyone who's not aware of what the triple lock is? Obviously, we love it. We talk about it daily, but some people might not be as in the trenches with this stuff as we are. So the triple lock is the measure that increases the state pension every year. So it makes sure that state pension doesn't just stay flat, it rises with rising prices or earnings. And so the triple lock measure is that state pension will either increase by the average earnings increase for that year, the average prices increased as measured by inflation, or if both of those measures are lower than a flat 2.5%. And so each year, obviously, depending on what's happening in the economy, a different one of those measures is likely to be used. For this year, we don't have the final confirmation yet, but it's likely that it may be the earnings figure that we rely on for that state pension increase. Now, for reasons that I'm sure there is solid logic to, they take the specific earnings figure for July as the measure for this. Why July? I don't know. Do you know, Charlene, or not?
I don't know. We had to triple check it ourselves, didn't we?
So that figure is now out. That figure came out this week, and so that gives us that earnings metric that could be used for the triple lock, and that has come in at 4.7%. So a meaty rise if the triple lock did rely on that. The final piece of the puzzle that we need is the inflation figure that it's measured against. That will come out soon, and then we will know. But obviously, while inflation is a bit higher than the 2% target at the moment, it is not near that 4.7%. And because the highest of these metrics is taken, it's likely that earnings figure will be the thing that determines the triple lock and that state pension increase for next year. So that is another significant increase to the state pension. So that means that the full new state pension should increase from the current £230.25 a week, which is just shy of £12,000 a year. That should increase up to £241.05 per week from April next year. That's when this comes into place. What that means is that that new state pension will now tip over the £12,500 mark. So that it would fall at £12,534.60 a year. So why is that particularly important? Well, because the amount that you can earn each year tax-free is £12,570 a year. And so that means we are getting very, very close to that limit and to people paying income tax on just their state pension, regardless of any other income.
Yeah, absolutely. And I think the thing to pick out there is that not everybody will be getting that full rate. Some people even get more than that already due to the way that state pensions used to be calculated. And some people might get less due to something called contracting out from the old days. But I think it is like a bit of a moment and something we've been looking out for a while, and certainly has been in the press, always sparks a lot of debate. And yeah, those figures are going to be watched very closely, that inflation figure that comes out later this month, next month for this month, and it's going to be watched, very closely by pensioners, policymakers alike, particularly with our upcoming budget.
The budget. I feel like we should have a budget klaxon for this podcast, because I feel like that topic is going to come up quite a lot in the next month or so. But I think it's really interesting that these figures and this amount will be confirmed ahead of that budget, and then it does pose a significant conundrum for Rachel Reeves and the Treasury, which is if we see that next increase in the state pension, that will then take it over that personal allowance. And whilst that isn't going to land pensioners with a huge tax bill on its own, I think it does feel like quite a moment and quite a significant hurdle to overcome. So it'll be interesting whether that's talked about in the budget or whether that becomes a hot topic in the lead up, like you say, Charlene. So whilst we'll obviously bring you all of the rumours in the run up to budget, we don't necessarily just need a budget to get changes. So last week we saw a move from the taxman to toughen up some of the rules around people claiming extra tax relief on their pension. So obviously, we're going to try and avoid jargon here like we always do, but we are talking about pension tax relief, so it's a little tricky not to slip into it, but we'll do our best. So Charlene, explain what has changed here.
Yeah, challenge accepted. So HMRC is making it tougher for people to claim extra tax relief that they think they're entitled to on their pension contributions. So why is it doing this? Well, they're arguing that some of the past claims have actually just been completely incorrect, and they're now insisting that everybody needs to get hold of evidence for their claim, no matter the size of it. Previously, until the 1st of September, you had to be claiming for a contribution of £10,000 or more. So now it's all of them. So who does this affect? Well, it's going to be a pain for some higher and additional rate taxpayers who are used to being able to claim this extra tax relief already, and they'll just now have to do some extra legwork. I guess in a way it provides a useful reminder to kind of go through these rules, and that everyone should check their pension arrangements and make sure they're not missing out themselves. So I think it's fair to say kind of many people will probably assume that they're getting the full tax relief that they're entitled to on their pension contributions, and that it's kind of handled by the pension providers or their employer. That is the case for lots of people, but it isn't true for everyone. And although what I'm about to say might feel like a faff, I think really claiming what you're owed could actually land you a rebate worth hundreds and sometimes thousands of pounds from the taxman. So very much still worth doing. So quick recap, it affects higher or additional rate taxpayers, as well as people in Scotland who pay the intermediate rate of tax and above there, because obviously we've got different bands and rates in Scotland compared to the rest of the UK. And it affects those people who are paying into pensions, but confusingly, not everyone who falls in that box. So Step one, if you're in these groups, I would suggest asking your HR department or your workplace pension provider how your contributions are made or how they're collected. So if they come back to you and say they are taken by salary sacrifice, or if you're in something called a net pay scheme, I'm sorry about the jargon, but it is a defined term. But if they come back saying one of those two things, then really you don't need to worry. A net pay scheme is where your contributions are taken from your income before tax, meaning you automatically get the tax relief. Your contribution's already tax-free. But if your employer offers something called a relief at source pension scheme, or you're paying into a private pension yourself, like a SIP or a ready-made pension, your contributions are paid in from your taxed earnings. So what happens there is HMRC automatically adds on 20% tax relief, but you then need to claim any extra tax relief owed to you above that basic rate. Hence why we're talking about sort of higher and intermediate taxpayers. It's worth noting, actually, I think most people think most workplace schemes aren't under this, but actually Nest, so the UK's largest workplace pension provider, actually operates relief at source as well. And it's got 13 million members. So really do check how your scheme is set up. Now, if you do fall into this, how do you claim? Perhaps you aren't claiming already. So if you already complete a self-assessment tax return, then you claim the extra tax relief via that process. That's not changing. But if you don't need to file, usually, the government online system is where you should go and where some people will be used to be going already. And it's here where these evidence requirements are now increasing. So as I mentioned, that £10,000 starting limit for evidence has now fallen away, meaning you'll need to speak to your pension provider and get some evidence of what you paid into the scheme throughout the year. So yeah, the message is, please make sure you're still claiming what you're entitled to. It's just that you might have to go through some extra admin faff and steps to actually get the money in your pocket.
And let's stick with the topic of retirement because, Charlene, you've been looking at how people's expectations match up with the reality of their spending once they stop working, which actually has thrown up some quite surprising figures in there about how much people think they'll need to retire on compared to what retirees actually spend. So tell us more.
Yeah, absolutely. So, it is still Pensions Awareness Week. And listeners who were listening in last week will know that we often refer to the retirement living standards that a organisation, I should say, called Pensions UK put together each year. I know Rachel stepped in for me last week on pensions and went through them. Now, I'm a fan of anything that really helps get people out of a rut when it comes to working out what they need. And they're great for that as a starting point. But clearly not everybody fits in neatly into those three boxes or those three lifestyles that they aim to kind of put a cost on. And not everyone listens to our pod, sadly. So I know. So we did commission some independent research to get our own feel for real life wants and expectations. So we asked, we're still going through some of this, but looking at those kind of first two questions we asked what level of annual income before tax do you think you'll need to enjoy a comfortable retirement? Now, we kind of defined what income meant, so total income before tax, but we left comfortable to the respondent to kind of think about. So the mean average came out at £39,400 a year. So that's £4,500 a year below the Pensions UK figure for a comfortable retirement, how they define it, which is nearly £44,000 now, but well ahead of their moderate estimate, which is £31,700 for a single person outside of London. Now, kind of looking through the figures, of course, we had some variation depending on where the respondent lived, with London and the Northwest actually coming in at over £50,000 and £40,000 a year, respectively. But what I thought was really interesting was the generational breakdown. I sometimes get a little bit triggered by these labels, but I will go through them for now. So Gen Z and millennials, they have much higher expectations for what they will need, kind of 50% higher than a Gen X person. So that's like a 50 plus, and almost double the 60 plus boomer generation. So kind of to me, that really indicates that younger generations are serious about what it's going to take to fund a comfortable retirement, however that looks like for them. And, I was kind of thinking about it. I'm a millennial here. As are you, and thinking about like kind of my grown-up life so far. It sounds ridiculous a bit, but I graduated straight into the global financial crisis, had children just before COVID and the cost of living crisis, My mortgage repayments are now double what they were when we moved here, etc., etc. So kind of without unleashing a kind of hippie side, I'm kind of trying to highlight that life events really shape how we feel about money and how we react to stuff. And obviously each generation has had its own ups and downs, but just kind of trying to relate it to a personal story. And the younger generations were also really aware that they need to save themselves for retirement. And most of them have no plans to rely on the state pension alone. They might be not feeling that positive about having to do that, but the acknowledgement and the kind of engagement with the need to save into things like pensions is actually really positive in my eyes. We're waiting for a bit more data on what they actually have managed to squirrel away so far in the face of kind of competing priorities, because time is really on their side. We also asked people how much they think they will have saved by the time they get to retirement. Again, looking at the mean average, that was £340,000, which is pretty close actually to the Pensions UK figure that they think you would need to generate that moderate lifestyle, so that slightly lower income after the state pension comes off. So is the message getting through? Are people using things like the standards to try and work out what they need? I think the signs are encouraging. And, you know, we've got some really exciting work coming down the line here at AJ Bell to kind of help people work out what their pensions might be able to give them and whether or not they need to take a little bit of action. So kind of watch the space here. And just to finish up, if this is not enough pensions chat for you, in Pensions Awareness Week, which is like Christmas week to me, our Power Up Your Pension campaign that Dan, Rachel and Danny talked about last week is still running. Got plenty of articles and videos tailored to different stages on the journey, because I know we talked a lot about people saving into pensions, but people are at different stages. And I was really proud to link up with the lovely guys at Consumer Champions, which for their own Pensions Week podcast, which will also be out at the same time as Money and Markets.
Oh, it's a podcast loving. That's great.
Yeah, it's great.
I think that's so interesting. I always love the, not just the figures and whether they align with probably what the reality is, but those generational differences are so interesting. But I think it is encouraging that broadly people are kind of aligned. They're not thinking wildly differently to what the reality might be in retirement. It shows maybe people have been listening to us, Charlene. I think it's entirely on us.
We'll take a bit of credit, but I think I sometimes worry that a lot of the way we talk about pensions and how people need to save can put people off, and it can be really intimidating and daunting when you hear some of these figures about what you need in your pot. So yeah, really encouraging size. Hopefully it is indicative of what's going on across the UK for people who are putting money away.
Yes, definitely. But next up, we have got our first interview this week, haven't we? Shifting into the investment landscape.
Yeah, absolutely. It is money and markets after all. So with more people looking beyond the US for investment opportunities, we dispatched our very own Dan Coatsworth to go and talk to two different fund managers who are beneficiaries of this trend. So first up, we've got Ben Preston from Orbis Global Equity Fund, who explains in this interview why he's got much less exposure to the US than a typical global fund and why he's gone big on the UK. Ben also talks about why he's invested in Japan's gaming giant, Nintendo.
Very pleased to be joined by Ben Preston, who's portfolio manager for Orbis Global Equity Fund. So Ben, great to see you. Hope you're well.
Thanks for having me.
Well, great. Well, Ben, your fund's performance has been very good. I thought some people might be quite surprised by the lack of these really big tech names in your portfolio, given sort of stocks like Nvidia and the like. So they've been responsible for big chunks of the US stock market's gains in recent years. So I'm just wondering, are you actually sort of shunning these really big tech companies completely, or are they sort of hiding away just as a smaller position in your portfolio?
Yeah, the stock markets have been driven heavily by those top few names. We haven't owned many of them. We have in the past, but more recently they've become bid up to prices where we no longer find them particularly attractive. But we're being really selective in that space. So something like Nvidia, where we think there's a lot of future growth baked into the price. They will have to achieve just to justify today's price. That becomes a little bit harder to find real value in the shares today. Something like TSMC, which is also a big cap tech company, but happens to be based outside the US. We see a lot more value there. And we actually think they're better positioned. Whether it's an Nvidia chip or a Broadcom chip or a Google chip that's going into one of these data centers, they're going to be made by TSMC. That's the real dominant manufacturer of leading edge chips. So I think there's a really strong competitive advantage there. And the shares are much more attractively priced as well. So less than 20 times earnings when you're paying over 30 times earnings for some of these big mega cap stocks in the US. So we haven't shunned them, but we are being selective. We try to be on the front foot.
Okay. I mean, just looking at the US, I think there's increasingly lots of people not that pleased with what's going on in terms of the potential impact of the Trump administration's policies. And, they're sort of concerned about potential slowdown in, the economy there, and looking at sort of trade relations. And perhaps that's all been a trigger for them to look elsewhere in the world for ideas. I was just wondering, where have you sort of been sniffing around in terms of beyond America for opportunities?
We've actually found more interesting and more by number investment opportunities outside the US than inside the US. So it's quite amazing. But today, the US market is something like over 60% of total world stock market value, which when you consider it's only 25% of the world GDP, 4% of the world's population, it strikes me as a little bit quirky that the received wisdom is that one should have the vast majority of one's assets in just one country in the world, and not just one country, but the most expensive one. So we found with our process, we've actually uncovered more opportunities outside the US than inside, and that's in places like Korea, Japan, Brazil, even, and even in the UK. So if you are willing to look beyond just the top few names, we think there's a lot better value out there.
So perhaps one company in your portfolio, which I think most people would know, Nintendo. To me, that's a really interesting business. It goes through sort of phases where people are like, well, saying it's a bit tired, needs something new. But actually, it's been sort of trying to sweat its intellectual property. We had that Mario Brothers film recently, did very well, the box office. And this year we've got the launch of a new gaming console, the Switch 2. So I think, people are starting to talk about this company a bit more optimistically. What is it that you like about Nintendo?
Well, when I was a kid and I had a Game Boy and a Super Nintendo entertainment system, they were great, but every time they introduced a new system, you'd have to chuck the whole one out, the old one out, because the cartridges wouldn't fit the new console, and you couldn't play any of your old games. They wouldn't develop any games for the old system. My kids got a Wii, and it was the same thing. Now they've really changed that business model. So the Switch 2 is an incremental improvement on the Switch, but the games are compatible. So you can play a new game on the old system, you can play an old game on the new console, and you can download them. So that's a much better experience for the gamers. It's also a better business model for Nintendo, because they don't have to throw out all of their development cost every time they come up with a new generation of product. So that's really nice. With the new Switch 2, you are going to be able to play games from other developers as well. So if you want to play, some of the big name games, historically you would have to buy an Xbox or a PlayStation to do that. It wouldn't be available on Nintendo, but now they will be. But of course, the Xbox and the PlayStation consoles can't play the Nintendo games. So we think that's a big advantage for Nintendo, which they've never had in the past. So we think the business model is changing for the better.
Okay. I mean, I guess the Switch 2 it's only been available for maybe a month, 2 months. So is there any sort of indication of how well that sold initially?
Well, it's hard to tell. It's hard to tell because in the beginning, when they launched this, they're all sold out. And it was very difficult to try and get one's hands on a Switch 2 console because everywhere you looked, they were all gone as soon as they came into stock. So it's really hard to judge at this point. So we have to judge by the reviews, by people that have tried the product. So far it's really encouraging. And we hope that goes well. But there's a lot they can do. As you mentioned in your preamble, they're now really starting to monetize these assets much more effectively than they were in the past. So it was just computer games. Now you can go and watch a Nintendo movie. You can go to a theme park. You can go to a shop and buy merchandise. So they're really tapping different avenues in how they can, make the best returns from the assets that they've got. And they're great assets. It's Mario Kart, it's Donkey Kong, it's Zelda, it's Pokemon.
Yeah. So I mean, there's I think a stock like Nintendo. There's a good sort of positive narrative about it. And actually, if you look at sort of stock markets around the world, they're generally sort of pushing higher. But what I thought was quite interesting is how if you look at bond markets, they're perhaps not as positive. In last sort of week, 2 weeks, we've had a bit of a wobble with certain parts of the bond market, government bonds. It's kind of sending mixed messages. I was just wondering, history suggests that actually don't ignore the bond investors. They're kind of smart guys, and if they get worried, you should sit up and take notice. What do you think that we're actually potentially could see another sort of bit of a wobble on the global stock market soon?
Well, you're right. There's a link between bond markets and stock markets, and the issue with bond markets now is that governments are borrowing, faster, higher amounts than ever before. And so the more they try to borrow, the more that might push up the cost of borrowing. And then that ripples across the economy, because if governments are having to pay more to borrow, then so will companies, and so will home buyers, and so will everybody else. And so that can be an issue. I'm not very good at predicting these types of things. We are much more driven by what's going on company by company. So the bigger danger that we see really is that these stock markets have become very, very narrow, with just the top 10 companies in the US now dominating stock markets worldwide, and they're trading at very expensive levels. And so the risk is, if something comes along and just slows the growth in AI or big tech generally, then that's something that investors have to watch out for. As investors have really, really herded into these top few companies, it's pushed the share prices higher and higher and higher. And then people feel they have to participate for fear of missing out. And the danger is that's when prices can go to an excess. I mean, it happened in gold in the 1970s. It happened with Japan in the 1980s, the Nasdaq in the 90s, mining companies in the 2010s. And so there's a risk. It's starting to feel a little bit like that now. That's what we see as the risk for stock market investors. The good news is, if you look outside that top group, there are still really good value companies to take advantage of. So that's what we're doing for our clients.
Because I think if we do get a sell-off in perhaps names like Nvidia or all those big expensive tech names, surely that would create negative sentiment and sort of drag the whole market down. So even if you were in cheaper stuff, everything would be caught up. But do you think it's a case of just being patient if that happened? That perhaps after that, investors would say, well, I'm no longer willing to pay top dollar for stocks. I'm going to be looking in value sort of areas of the market, and then perhaps that would naturally sort of shine the light on what you're doing at the moment.
Yeah, I think so. So stock market sentiment is fickle. These two major emotions of greed and fear tend to dominate the way that prices go either up or down. And so you do get volatility. What we try to do, the clearest way for your viewers to try and get through that fog, if you like, is to be really disciplined about buying companies for less than they're truly worth. And if you're just buying an asset for less than it's truly worth, then you can withstand a lot of volatility and still come out ahead. So that's the way we try to think about it. Just keep thinking long term. These sentiments will ebb and flow, but if you stick to the mission, the rewards from this kind of philosophy can be dramatically more rewarding than being buffeted around by the big questions of whether the stock market's going to go up or down.
That was Ben Preston from Orbis Global Equity Fund. So next up, we're going to hear from one of the many fund managers whose phone has been ringing off the hook this year as investors find a new love of Europe. So Dan spoke with Daniel Avigad, who's portfolio manager from Lansdowne European Special Situations Fund, about whether it's too late to benefit from strong stock market returns in Europe, and why the owner of Ray-Ban is really catching his eye. Let's hear what he had to say.
So I'm very pleased to be joined by Daniel Avigad, portfolio manager from Lansdowne European Special Situations Fund. So Daniel, thanks ever so much for joining us today. Hope you're well.
Yes, thanks for having me.
Well, Europe is definitely one of the big stories for investors this year. I'm kind of just interested to get your opinion about what's made people sit up and take notice of Europe as a potentially good place to park their money.
Well, I think that is primarily driven by the shift in sentiment towards the US. So it's mostly, at least originally, an exogenous influence, as well as many will know. We started the year with quite a high degree of investment in a small number of companies inside the US, and valuations, certainly versus history, looked quite expensive. I think when we moved into a phase of greater policy uncertainty, tariffs, for example, being one aspect of that, it became it became a bit more risky to be holed up in one area to such a degree, and so the market looked in lots of ways to diversify. One example of which is how we've seen the dollar depreciate, and I think you can see that permeating through lots of different asset classes and geographies. Europe being a principal beneficiary, with domestic Europe, those companies least exposed to the dependence on the US actually performing the best in line with how the currency has moved. So that's how it started, and that was accompanied and it's not just been that exogenous driver. There's also been an endogenous one. I think the risk of policy turning more uncertain in the US has conversely been getting less uncertain in Europe, of course, with the German debt brake being removed and a major fiscal injection in Europe's largest economy, helping to improve sentiment, if not confidence.
I think the stuff that's going on in Germany is just, definitely seems to sort of caught investors' attention. It feels like, if Germany's going to be spending more on stuff like defense, construction, clearly those sectors have been in demand, and we've seen pretty strong share price gains. Same with the banking sector, which is obviously kind of linked to it. But I'm just wondering if you thought actually this all this good news around potentially what might be happening in Germany is now fully priced in, and those sort of obvious key areas in the European markets are, if you're not already in it, you've missed the boat, sort of thing.
Yeah, I think it's an interesting question. I agree. I think for further gains or materially in a reasonably proximate period of time, one would want to see evidence that Europe is able to propel itself from here, as opposed to benefiting from not being, the US. And I think that will require the example set by Germany to mutate into a sort of more long-term strategy to improve Europe's economic growth potential. So the first step was a sort of removal of a debt brake, which is a debt-funded fiscal stimulus. So that's spending more money up front to boost the economy. But actually, in the long run, that's a relatively temporary benefit. And what one needs to do is improve the productivity potential of the economy by making a whole series of reforms. And whether that happens, I think, will determine the fate of those areas of the market you just described and how they can kick on from here or not. So it's really a political question to a large degree.
Yeah, I mean, just looking at obviously your approach as an investor, one of the things you seem to like doing is you like to spot industries that have got tailwinds, such as regulation or structural changes. And I noticed, like, one of your holdings, Essilor, they're pretty much a company, everything to do with eyewear, so prescription glasses, sunglasses, optical equipment. So obviously there must be a clear sort of tailwind here. We're all staring at our screens every day, looking at our phones, and I guess people's eyesights are deteriorating because they're squinting their eyes so much. Again, a bit like the question around Germany, is that sort of that good news, this tailwind for a company like Essilor, is that not really obvious? And isn't that the earnings potential already priced into that stock?
Yeah, again, a very fair question. It's obviously done very well. I think our position commensurately has reduced as some of that upside has been reflected. It's it is very powerful, the tailwinds it's benefiting from. There aren't so many industries that continue to outgrow the economies in which they're present because of drivers that are not linked to the economic cycle. Just like you said, the eyewear is increasing independent of consumer wealth, simply because of the change in consumer habits. We're just spending our time at work, at school, at home, in front of screens. And also the aging economy means that a problem called presbyopia, which is only apparent after the age of something 40 plus, it's just a greater portion of the population. So I can see how the structural drivers are very solid. And on top of that, we may be in the midst of a transition in technology terms that will favor the eye care industry. I don't know if you've had the chance to use the Ray-Ban Meta glasses, which are essentially connected to the internet. And I do that, for example, on my train home, just to listen to podcasts. To the extent that that really gets mass market appeal, and it's something that Meta is particularly excited about and funding a lot of the research to miniaturize the technology. I wouldn't say the upside is fully monetized. So there's an option value there, a potential real upside if that really takes off. That could make the shares still very attractive. But, it's sort of a balance between that and the fact that, some of the core strengths of it, which is just greater awareness that people are going to need to wear more glasses, is already captured.
Yeah. I mean, did Essilor, do they own the Ray-Ban brand, or are they just licensing it? Or
yeah, that's their brand, exactly. So they bought that 20 or 30 years ago. They also own Oakley. Both of those are in partnership now with Meta to create these connected eyewear applications.
Okay. Well, so just another stock in your portfolio, Ryanair. Obviously, I think everyone listening or watching this will be familiar with what they do. But the airline industry is incredibly competitive. I think it's fair to say that Ryanair has got some quite clever ideas about how to get more money per passenger. Longer term, why do you think Ryanair is ultimately going to be a winner in the European airline industry, given that really there's so much choice? If you're a passenger, you don't really need to have brand loyalty, do you?
Yeah, I mean, I think, to paraphrase perhaps the company, lowest cost always wins. We think that seats on aircraft in Europe is effectively a commodity, and the winner in any industry that is a commodity is the lowest cost producer, because they can make a spread between the price at which the fare is set and their own cost structure. And Ryanair has been hyper focused on reducing and optimizing their cost structure in a way that hasn't been replicated successfully by any of their competitors over decades. And that means that they are able to make profits on each seat to a greater degree than their rivals, and they reinvest that in growing. And that's very attractive, because if you can bring passenger growth to an airport or to an aeroplane manufacturer or to pilots, that creates opportunities for win-wins. And that means that they get the best terms in each element of their cost line. And that maintains or sustains or even advances their cost advantage, which again creates this virtuous flywheel, which has meant that in a very challenging industry, because it's very cyclical economically, they have consistently generated very attractive returns on capital, and they continue to take market share and advantage, and their scale advantage just expands continuously.
Yeah. And what sort of other things are catching your eye at the moment? I think when you look at Europe, whilst people think it might not have sort of the excitement, in terms of sort of the big tech companies you might find in the US, there's quite a broad range of industries, isn't there? There's plenty for you to choose from.
Yeah, there's really loads right now. There's sort of four things that we're looking at: regulatory changes you alluded to, technological disruption, consumer habits are shifting, and because the interest rate cycle is moving, that can really affect the amount of competition in different industries. And that all four are firing at the moment simultaneously, which is very exciting. Example you asked for, telecoms. So the network operators, it's normally a boring industry if you think of BT, but actually we think that the regulatory environment in Europe may be coalescing upon recognition that for Europe to be a high-speed digital economy, we need a lot of investment in the next generation of broadband infrastructure, both fixed line and mobile. And that costs a lot of money. You need a lot of scale. So the idea is that we may start to allow, from a regulatory policy perspective, a fewer number of networks to be built so that they can be built better. And that, of course, the competitiveness of all Europe's industrial economy is predicated on that connectivity. And the European sort of productivity gap, we think, is partly a consequence of that lack of investment, which is coming to the forefront in the minds of lots of institutions and stakeholders. So that might be changing to the benefit of those telecom operators, we think.
That was Daniel Avigad, who is portfolio manager at the Lansdowne European Special Situations Fund. And if you enjoyed these experts talk about investing in parts of the world that aren't the US, then don't miss next week's podcast, because Danny Hewson is going to be talking to an expert about all things Asia related.
Yeah, the guys, Dan and Danny, have really gone in with all the interviews to bring you in this series. I don't know what they've been doing over summer, but they've gone wild. We've got loads. But that is all we've got time for this week. As always, you can find more details on all of these stories on the AJ Bell website and our social channels. And don't forget to subscribe to the podcast wherever you listen so you don't miss an episode.
Thanks for listening. And Charlene will be back next week with Dan Coatsworth also in the hot seat. And we will see you next time. Goodbye.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.